Hey guys, I want to welcome you to the weekly Wednesday for the Financial Freedom newsletter, where every week, every Wednesday, we delve into something inspirational, motivational, something excerpt taken from the Financial Freedom weekly newsletter. Wherever you are, if you're listening on Spotify, on iTunes, Google, be sure to click the like, subscribe, share, comment. And without ado, let's get into the show. Welcome everybody to this week's podcast episode for the Financial Freedom Podcast. I'm your host, Dr. Christopher Liu. And as you know, I talk about 4 different types of freedom: time, financial, location, health freedom. In that light, I'm always interviewing entrepreneurs, people doing things on the cutting edge, getting their insights and sharing that with you. So today we have Josh Dudick, and his mantra is helping you make money and build wealth in finance and in business. So his expertise includes 15 years on Wall Street, investment banking, and also helping others manage their finances and build wealth. And so today's going to be talking all about investing, how to save, grow, protect your money, passive income. So it's going to be a great discussion on finances. So Josh, welcome.
Hey, Chris, excited to be here. Thanks for having me today.
Like I said, markets are quite interesting. Fed raised the interest rates 50 basis points. So, we're kind of turning the thing. It's kind of hard to see where we're going to go. So first thing is, tell us more about yourself and we'll get started.
Sure. So, as you said, my background is on Wall Street, mostly as an ETF arbitrage trader, which means I spent most of my career taking apart ETFs, which are exchange traded funds, and don't need to get into all the nitty gritty of it. But basically, I'm sure your audience knows a little bit about these. These are the more common new form of mutual funds, and I think this is kind of the more valuable investment vehicle for most, investors that would be listening. We're talking passive index ETFs. So, for example, if you've ever heard of the SPY, the most common, most liquid ETF that exists. And this is basically what I did for 15 years. I kind of took apart these products. I traded them. We market made them. We worked with different issuers, such as the big ETF houses like BlackRock, Vanguard, Schwab, and would even help them list these on New York Stock Exchange, on NASDAQ, and basically just spent a lot of my career figuring out how to provide liquid markets for retail investors, how to make some money on our end as a trading firm. And that's most of my background in the beginning of my career. And over the last couple of years, I've now shifted to try to build a financial literacy brand, which is called Top Dollar. And there I'm just basically trying to share a lot of my background and knowledge, and kind of just upgrading a lot of the basic financial literacy that, is out there that people learn from financial analysts, but a little more nuance with some better ideas for tax optimization, for a little more sophistication.
Yeah, it's quite interesting. I love this idea where you make your name, you make your fortune in some fields such as finance or, medicine, business, tech. And then, so what that's interesting is, and I love this transition where you're sharing it and you're giving and your online personality. And so tell us that you have some confessions of a former Wall Street trader and now your new life as an online personality and blogger. Tell us more about that.
Sure. So, it's funny. So my career actually spent most of my time. I worked at a bunch of different firms, but I spent quite a bit of time at one firm. I won't mention it by name, but it was actually an international firm. So we were headquartered in Amsterdam, and I lived in Amsterdam for a year and then helped build a New York office for this company. And, it's quite funny when you watch, movies like The Wolf of Wall Street and stuff, because, this wasn't quite the 80s and 90s of the craziest, time, but it was pretty wild, and people are outrageous and they make quite a lot of money and kind of aren't always trying to give back and understand, what the goal is of all of this. And, in my mind, it's always been about kind of, like you said, Chris, like figuring out how I could use a lot of what I've learned to teach others and help others. But I've definitely seen a lot of wildness over my career on Wall Street. It's been a exciting ride.
Yeah, it's interesting. Whenever you're talking about money, you always have, the well-intentioned people, but you also have the greed and all the bad actors come out. This year is no different. But let's see here. What's interesting is you talk about firing your financial advisor. That's kind of counterintuitive. People think, your financial advisor is, tell us more about that.
Yeah, I think what's kind of I think it's an interesting concept. And I think, you kind of always have to consider where you are on the class of needing financial advice or wanting to do it yourself. And I understand that, for some people, gaining the financial knowledge and gaining the literacy is maybe not worth their time. I mean, maybe they have their opportunity cost for their time is too high. I know maybe in medicine, that's the case for a lot of doctors where, they just feel like they don't have enough time as physicians and they want to spend, they rather spend their time with their family and their friends and just spend a little extra to a financial advisor to do it for them. But, what I've come to realize is, you don't always necessarily get what you pay for in the financial advisory world. I think there's constantly, I've tried out personally some financial advisors, even though this is my area of expertise. I have plenty of friends in the finance world who know a lot, who still use advisors. Generally spoken, they're not necessarily getting the best bang for their buck. And the irony is, financial advisors charge quite a lot of money for the services they provide. Obviously, there's a lot of different fee structures, but the most common one is some sort of blanket wrap fee, a percentage of your overall assets under management, whether it be, 2%, 1%. Now there's robo advisors, which are very competitive, who do it automatically for 40 bips, which is 0.4%. But when you actually start to calculate out how much this cost, on even, let's say, a hypothetically, let's say you had $1 million investment, it might only seem like, well, $10,000 a year is a small price to pay to know I'm doing it right. Obviously, $10,000 is a lot of money for a lot of people. But when you start to compound that drag and that money and how much that would compound for years in the stock market or in the bond market or whatever your portfolio asset allocation is, over the general lifetime of an investor, call it between 25 to 50 years, that will definitely cost you, millions of dollars for most investors. So it's a little bit counterintuitive, of course, but I think the crux of my argument is that even if you could learn to do the basic stuff, and I think everyone out there can, it's not rocket science. It's very doable. And even if you were doing it 50, 60, 70% as good as a financial advisor, you'd probably still come out on top because of all the savings. So I just want to open people's minds to understanding this isn't some sort of voodoo or some sort of, you need an advisor to come up with all these great ideas. I think for the most part, it's a lot of set it, forget it. I think some of these tools out there we were talking about, such as passive index ETFs, give the everyday investor a really good vehicle right now to kind of be able to diversify, invest smartly. And that's kind of a bit of the message I support these days.
Yeah. Again, this information is not advice but what money habits should, average people be making regularly?
I mean, I think it goes without saying the number one rule is to invest early. And, this is common knowledge that people have been saying for years. And I hope it, heeds with people. But the power of compounding is mostly a game of time. And I always love to talk about the rule of 72. And if you don't know the rule of 72, it's quite easy. Basically, it just determines how long it takes your money to double. And it's, you take the interest rate and the number of years, the interest rate and percentage and the number of years, and that's your doubling time. So for example, if 9 times 8 is 72, that means at 9% annual return, it would take you 8 years to double your money. And, when you start to think about this and what, stock market returns are, and I think stock market returns are at about 12% annualized since World War II, you could kind of start to put together the math and say, wow, I could double my money pretty quickly. And I think that's just a really powerful tool. So I think starting early is definitely the most beneficial. I mean, there's no, starting at 24 versus starting at 30, those are years that you could, even putting in an extra $100,000 or $200,000 could equal, well over $1 million over those, extra 6 years of starting to invest. So really the number one rule is starting early. There's definitely more to build on than that. But if there was a number one rule, that's definitely it.
Yeah, always again the power of time, and then I think Einstein was saying that compounding is the eighth wonder of the world. So take advantage of that. And it's interesting because doctors, they actually wait; they're actually 20 years behind someone who actually starts investing in their 20s. So excuse me. The other thing I have question is where you say where should people be investing their money? Equities, real estate, especially with this interest rate risk and volatility. What are your thoughts on that?
Sure. I think the most important thing for most investors who are not professionals is to not try to overplay the market. I in an environment now where stocks have been beat up this year and are down 15%, and inflation is high and rates are going up and mortgage rates are, maybe now they just seem to have topped. And I think it's not really about trying to time, but it's kind of looking at historical returns, and that's the best we could do. We could look at what's happened last 50, 75, 100 years, try to use them as somewhat intelligent models for what we could expect. So we have some sort of benchmark. And when you stick to that kind of model, it kind of behooves you to invest more heavily in equities. Years back, I think more people were all about stock picking, and there's still plenty of people who are into stock picking. But again, I highly support, passive index ETFs that are well diversified. There's also some really great tax advantages there too. Which basically takes out the need to try to, play professional trader or professional investor, trying to time the markets. I mean, I think the hardest thing for most people that they don't even really think about is it's not about trying to time the market when you buy. You have to do it twice to be successful, because you have to figure out when to sell it and try to sell it at the top. Plus, then you end up paying some sort of capital gains or some sort of tax. And in order to kind of play that both ways on stock picking is not necessary, or even bond picking is not the most intelligent choice for, I think, most people to get it right all the time. So I think it's a sensible allocation to go between stocks and bonds. Again, I think everyone has to kind of think about their risk appetite, their portfolio that's right for them. I talk a lot about this on my site, and I have kind of some do it yourself, more for education, not investing advice, but how I would recommend someone to go about building their first portfolio and think about how much risk are you comfortable with. I analyze, the past 7 big market crashes, starting with the financial crisis. We look at COVID, we go back to the Great Depression, just to kind of have an understanding of what really a nasty pullback in the stock market could look like, and how much are you comfortable with, and how much could you take. And then I think you start building a portfolio that's mostly based out of stocks and bonds. And once you get a little more sophisticated, you could look at some alternatives like real estate and some other passive investing products.
Yeah, it's interesting because you talk about one thing is this idea where especially coming around, like I said, we're actually turning a corner because we're coming toward the end of the year, and then we're not sure what 2023 holds, and then plus we still have this interest rate. What are your thoughts on the market, the economy, macro? What are your thoughts?
Sure. Well, first, the most important thing to understand is the markets and the economy are two totally different animals. Markets do not always do what the economy is doing, and I think that's kind of important to remember and think about going into 2023. A lot of people are nervous about a recession, or technically we might even be in a recession, right? Because a lot of the data that proves whether or not we're in a recession is backdated and lags. So it's quite possible we're in a recession. We're going to be in a recession. Most people have been waving the white flag on recession for the last year now, but I don't think that's necessarily the cause of concern to sell or to liquidate. Again, I don't think anyone should be trying to time the markets, especially on the downside of trying to think that, the markets are going to go way down much lower. We've definitely had a tumultuous 2022. The markets have been down as much as, 20, 25% almost. Here we are coming into the end of the year at maybe down 15%. I mean, personally, my feeling is that 2023 will be probably pretty strong and positive for the markets. I think Some sectors might perform better than others just because of the nature of this interest rate environment. And that's going to create some interesting lag, because we definitely know from a macro perspective that the Fed's going to be raising rates a little bit. They're going to slow, but they're still full on fighting inflation. And when you have rates still going up and you have projected growth going down, it's not the best combination for the market. However, it's always darkest right before the dawn. And, the best time to ever invest is not when everyone is saying, oh, this market could only go up and you're buying the new highs. When you want to be invested is kind of these days. So I think right now, if you're already invested or if you're not, it's definitely it'll in the long run, you'll look at this as assuming you have a 5+ year perspective, you'll look at this as a pretty smart, sensible time to come in when stocks are kind of priced at more reasonable multiples or valuation.
Yeah, always it's very important during these downtimes to always, dollar cost average, always be in. And then what you talk about, this timing, which brings us to this question: what is this different? A lot of new people, new investors, they think what you just described, they have to get in at a certain point and get out. What is the difference between investing and trading, and what should someone do?
Sure. I mean, I think that the main difference is that investors have to have a long-term horizon. And maybe let me correct that a little bit. It doesn't have to necessarily be a long-term horizon, because savvy investors, plan and look at their entire financial goals. And some of those could be short-term goals. You might be starting a family and you might need a home in the next 5 years. But basically, investors kind of look across what their financial goals will be, what their financial needs will be, and they come up with a strategy and a plan, and they decide how much risk they're going to take, where they're going to allocate their assets, whether it be in stocks, whether it be in individual stocks, whether it be in some of these other asset classes we've discussed. And they're kind of in it for the long run. They might still get shaken up when the markets are up and down and they're volatile. But, an investor is kind of looking for the long-term trajectory. Like we were saying before, stocks have gone up, and over the last 75 years, 12%, bond markets have gone up 6%. And, they're looking to ride those long-term trends. Obviously, you could get on or off the train, at the wrong moments or at the better moments. But long-term investors should be way less concerned about trying to time or get in better. And I don't necessarily, I deviate a little bit from the traditional viewpoint that I think a long-term investor could think a little bit about, if the market's a little cheap or a little expensive, but you have to have a general plan. And when you talk about dollar cost averaging, I do agree. If you have a set amount that needs to be invested, you might want to give yourself a little bit of a threshold where you play with, an extra 10 or 15% of how much the investment's going to go in. But at the end of the day, if your paychecks are coming in, a good chunk of that money should be invested, whether or not you feel that the market is too high or too low. Whereas, traders are generally looking to profit from short term. And by short term, that's a relative term. In my old business of ETF arbitrage, we would build high frequency, low latency trading systems. Short term, we would measure in microseconds, but I think for most traders, when they say short term, they're looking for less than a month. Some people are day trading, swing trading in and out within a day. Some are looking short term within a week, but generally they're looking to profit from trends. And I'm not to say that trading doesn't work, but I'm also not trying to support that people get into trading. There's financial professionals who do it. There's a lot of amateurs who do it. Everyone does not do it well, whether or not they have background or education in it. I think the investing side is really where the average person with a sound strategy and good discipline could perform as well or better than anyone.
Josh, very fascinating discussion, very knowledgeable. Tell us how people can find you, follow you, visit your website, etc.
Totally. So right now, I have a website at topdollarinvestor.com where I'm putting out as much content as I can. It's all free. The idea is just to give more advice on investing, retirement, starting to build out some stuff on real estate. I've owned some real estate properties, and I've done a whole bunch of stuff there, which I'd love to discuss and share. As well as I'm also active on Twitter as at @TopDollarInvest. You could find me there as well. And I hope to just be putting out more and more content going forward over the next year plus.
Yeah. And for all the audience out there, be sure to check out Josh's resources will be in the links and show notes. Check out his website, talking about being a millionaire, having a house in the Hamptons, and and tons of resources. So be sure to follow him on social media. So Josh, thanks so much for a wonderful discussion, and thanks for coming on to the show.
Thanks a lot for having me today, Chris. Hope to talk again soon.
I hope you really enjoyed that wonderful, inspirational, motivational piece. Again, wherever you are listening, if you liked it, be sure to like, comment, share, subscribe. We're on everywhere: Spotify, iTunes, Google, Amazon, Audible. And without much ado, be sure to thank this show's sponsors, and we'll see you next week.